we get started because the actual pattern is forming of what I just talked about on the first video. And this is exactly what we look for before we place a trade. Is that right here? This is the exact same pattern that I showed you guys on the last video, right here. Exact same pattern. Remember I told you when you see it comes back to this mark, that's when you buy or sell. That's what we're about to get ready to do right now. The pattern is there. This is the 15-minute chart at the SPY. We're gonna place two contracts though. One buying and one selling. If I have a better, I don't want to say the word feeling, but if I have a better feeling that the market is going to go down than it's going to go up, I would buy more put contracts than I would calls. Vice versa. Right here, it looks like it's going to be a good bounce. We don't know how high. But another thing I'm going to show you guys, um, I'll show you probably in the next video, is what to do when you see these candlesticks, the one out like that and the next one being flat. I'll show you that in the next video, hopefully, prayerfully. But let's see if we can get it. Contracts today that you can purchase today are going to expire worthless in less than 2 hours. So I don't know about getting one today. But I'm looking at the ones for the 22nd. Those are kind of. Let's see what we got here. $461. I mean, we might have an overnight. I'm thinking we might have an overnight rally, or not rally, but at least a good bounce overnight. The next mark that I'm looking at the market to, if it was to go up, the next mark that I would be looking at will be the 461, and that's on the SPY contract. That's a call. So let me see how much the 461 costs. The 461 for December the 22nd. Well, the 462 is $52. Now, if it was to continue to go down overnight, I would look for it to go to. So with my strategy, I pretty much buy and sell both sides. If it was to go down, if it was to continue to rally down, which I don't really think it will, but I would, definitely look 439. Let me see what that is, 439. So 461 on the call, 439 on the put. And I'm looking at December the 22nd. 460, 462 is 460 is $91. And the way I purchased, okay, this is E-Trade, right? Calls means that when you purchase a call, it's because you think the market is gonna go up. When you purchase a put, which you see it right there, it says put, it's because you think the market is gonna go down. Call means you think the market is gonna go up. What I pretty much do is, you see it says 91 cents, so I would times that by 100. And that's how much it'll cost you. It says 0.91 times 100, it'd be about $91. Same thing on the put side. This 291 will cost you $290, $291. Okay? So let me see how much your 440 is. 37 cents. $37. Let's see what we're gonna do here. You know, like I said, I feel better about it going up. I'm always buying and selling to be on the safe side. But because of the contracts, they allow you to get in the money. You can actually, even though you buy and sell, you can still profit. Because even though you have a contract on both sides, the value of the contracts are not going to be the same on both sides. So that's the good part. Let me look at this again because I'm looking at getting some overnight contracts just in case we get a rally overnight. And this is the reason that I'm buying, because of the same shape that I just got for you guys. It's forming right. Let me hurry up and get at least contract while I'm thinking about it. That's a mistake that I make a lot, is not acting soon enough. And so let's it's very simple, guys, when you're buying a contract. See, it says one call is $92. So I'm placing that order for the call. And honestly, if it wasn't for the market closing, I wouldn't even get the put until it broke through the support. See, this is what I call the support. This 452.87, that's what I call the support. That's what I call the support. So I just bought a call because I'm thinking the market is gonna bounce up. They say it dropped a lot because of the fear of the new variant that's out. But if it's gonna continue to rally, if it's gonna continue to drop, we're looking at another support at like 439. We're looking at this thing hitting like 440 if it was to drop overnight. So let me go ahead and buy a put. Let me see if I can get a put for like 440. Look at that. That's 64 million. Look at the volume. Honestly, the amount I'm just thinking the amount that it's been dropping today, I don't see it. You know, I really don't see it going to 440 without retracing back, but it's possible. So that's why I like to buy and sell. You know what? Let me do 3 contracts of 440. Or matter of fact, let's do 442. Let's do 2 put contracts for 442. Now this is the time. This is the point. This is the bookkeeping accounting part that we're getting into now. Let me see if I can find my notebook anywhere. My notebook, and I also need a pen. Well, I don't see it anywhere. But let me show you. Let me show you guys something. Okay, this is how we're. This is the math. This is the ideology behind this. If I buy 2 contracts at 442, remember I told you to times that by 100. That's $5,400, right? I mean not $54. I'm sorry, $54 times 2. So that's 108. That's what it's gonna cost. Or the axe price 110 is what it's gonna cost for 2 contracts, right? And if the market was to go from 442 to 4, if it was to drop another $10, 110 for 2 contracts will be 289 times 2. So that'll be almost $600 for another. If the market was to drop overnight $10 again because of the variant, that means that an investment of $110 will turn into almost $600. It'll be $289 times 2. I'm sorry, that's what I'm looking at right there. Now on the other hand, so I'm about to get 2 put contracts, but on the other hand, I have 1 call. I believe I bought the call at 460, and so if the market was to go up $6, that 1 contract for 460, that 1 contract at 460, for $90, that investment of $90 will be worth. And I think I might do another video to kind of break these numbers down a little bit more. A $6 move will make it $313. So what would happen is if the market rallied up overnight, I will make $313 roughly on the call, but then I would lose from the 2 puts that I bought, which are $110. So you deduct 313 minus 110, that goes your profit. On the other hand, if the market was to just drop overnight, then I would make the 55 times 2, which is, I mean, I would have spent $110 for 2 contracts, 442. And if it was a drop $10, then that would be about almost $500 profit minus the $90 I spent for the call. So you're looking at $400 profit. So either way it goes, if we have enough movement in the market, if it reaches the next points that I pointed on the charts, we would be able to make profit. So let's do that right now. Let's get these two puts for 442. Okay, that's $93 for two puts that expire on Wednesday, on the 22nd. That's $93, right? So now I got, look at that. Now I just bought the call, right? I just bought the one call for about $90. And I just bought two puts for about, I just bought two puts for about 110. And so here, if you look here, the market value of the two puts is where is it at? Is 101. I mean, the market value for the two puts is $89, and for the call is 101. So if the most you can lose is the amount that you bought the contract for. I bought two contracts. I bought two call option contracts, and I also bought one put option contract. And I'm thinking about buying another call option contract. Let's go look at the chart. So I mean, I hope that I covered, I hope that I covered some things for you guys on these videos here. Hope that I was able to cover a lot for you. Be back on here tomorrow. And we're in the game right now. We're gonna ride them overnight. We got the two calls, we got the two puts, and we got two puts and we got one call contract. So we're gonna see what happens tomorrow, and we're gonna follow up from there. God bless you, and I'll see you guys soon.